Welcome to my channel Commerce Specialist, where you'll find video covering various qualifications, whether it be academic or professional. Ladies and gentlemen, today's topic is very interesting and important. The topic we are going to discuss today is statement of cash flows. First of all, let's talk about what are cash flow statements and why do we need to prepare them. We all understand that companies prepare financial statements. One of the financial statements we have is statement of comprehensive income. If a business has posted profit after tax $500 million, that does not mean they have this much cash available at their disposal. So what we need to understand is the amount of reported profit and the cash balance are two different things. This is where shareholders get misled. This is where not only shareholders but stakeholders get misled. Taking a very small example, if you go for a bank loan, if you are a company, you need a bank loan, you go to the bank, you apply for a loan, the very first thing they ask you is to provide your financial statements. Now, when I say financial statements, I mean statement of comprehensive income, statement of financial position, statement of cash flows, statement of showing changes in owner's equity, and notes to the accounts. So please understand, making or not making cash flow is not an option. If you are a company, you have to prepare financial statements, and statement of cash flows are one of the main component of financial statements. So we were talking about going and asking for a bank loan. Banks, when we present them our financial statements, bank will look at the cash flows. Now you'll be thinking, why? Please understand that profits can be manipulated. By changing or adopting different policies, accounting policies, profits can always be manipulated. And we all know that profit is calculated on accrual basis, which simply means if a business says, if not this much, let's say they have $100 million after tax profit. After tax profit or profit after tax, whatever you call it. If a business reports this much profit, that does not necessarily mean that the business have enough cash to pay their liabilities. Why? Because most of the time the sales are on credit, money is tied up in receivables, customers have not paid you. On the books you may show very encouraging amounts of profits, but that does not mean you have the available cash with you. So two important things we need to know. Number one, making or not making cash flow is not an option. It's mandatory, especially for public limited companies. Number two, that cash flows gives you the bigger picture of the company. Profitability, yes, it's one of the indicators that the company is profitable. But is the company able to pay their liabilities on time? Is the company liquid enough? Is there a liquidity crisis? Is there a solvency crisis? By liquidity, I mean, can the company pay their liabilities, their short-term liabilities on time? Do they have enough money? By solvency, I'm talking about, is the business in a position to pay their long-term commitments when they become due? So profitability is not the only criteria of performance. We also have to look at the liquidity and solvency. And to do that, we need to know how to prepare cash flow statements. And today we are talking about cash flow statements as per IAS 7, the International Accounting Standard 7, which governs cash flow statements. So let's look at the format which is suggested by IAS 7. So I've prepared a cash flow format as per IAS 7. IAS 7 specifically requires cash flows to be segregated into three different parts. Cash flow from operating activities, cash flow from investing activities, and financing activities. Now, when I say cash flow, I mean cash coming into the business and going out. That means cash receipts and payments. So the very first part of cash flow is cash flow from operating activities. So what is meant by operating activities? Operating activity means cash coming in and going out due to sale and purchase of goods and services. So when I say cash flows, I mean cash inflows and outflows both. So cash flow from operating activity will give us the cash inflows and outflows due to buying and selling of goods and services. So let's see how we begin. So if you look at the format, we begin with operating profit. Now, what is the meaning of operating profit? Operating profit means earning before interest and tax. Or you can also call it PBIT. I've written it very clearly here. Operating profit, EBIT or PBIT, they are the same. So there will be certain questions in which EBIT or operating profit is not given. So you have to calculate. How do you calculate? Sales minus cost of goods sold minus all the operating expenses other than interest and taxes. So from sales, when you minus cost of goods sold, you get gross profit. From gross profit, you minus all the operating expenses, but do not subtract interest expense and tax. You will get operating profit. So once you get operating profit, the very first adjustment to that is, we call it working capital adjustment. When I say working capital, I mean current assets and current liability. So in the operating profit, if you look at this, this is your operating profit. In your operating profit, you have to look at, are your current assets increasing or decreasing over the years? When I say over the year, I mean 2 comparative years. Because as per IAS 1, whenever you prepare financial statements, you prepare for 2 comparative years, like for example, year 2018 and 2019. So from 2018 to 2019, you have to look at your current asset except cash and bank balances. So when I'm talking about current asset except cash and bank, I'm talking about receivables, closing stock, prepayments, so on and so forth. So what you have to look at is, start off with your operating profit. If your current assets over the year, let's say for receivables, if your receivables are decreasing, in 2018 it was, let's say, 80,000, and in 2019 it became 70,000, the difference 10,000 will be added to your operating profit. If you could see here, it says operating profit add decrease in current assets. Likewise, if your current liabilities are increasing over the year, for example, your accounts payable, creditors, if they're increasing over the years, that too you have to add. If you could see here, increase in current liability. So keep in mind, decrease in current assets, increase in current liabilities, both are added to your operating profit. Other than that, if there is any loss on sale of non-current assets, you call it loss on disposals. If there is depreciation, there is amortization, all that are added to operating profit. Decrease in current assets are added, increase in current assets are subtracted. Look, this arrow sign up is increase in current assets. Subtracted means in bracket. And increase in current liability is added. Decrease is subtracted, increase is added. All losses are added, gains are subtracted. So let me give you a quick recap. Start off with operating profit, as it says here, operating profit. Look at the working capital adjustments. If your current assets are decreasing over the years, you have to add. If you could see here, this arrow down shows decrease in current assets, you add. If your current liabilities are increasing over the years, you add. So decrease in current assets are added, increase in current liabilities are added. All losses on disposals are added, depreciation for the year is added, impairment and amortization for the year is added. Now we're coming to what do we subtract? Exactly the opposite. If you notice here, decrease in current assets are added. Look, without bracket means you are adding it. But increase in current assets are subtracted. Decrease, if you look at here, increase in current liability is added, but decrease in current liability will be subtracted. Losses are added here, but gains are subtracted. And in the end, let me put an asterisk here. The amount of interest paid and taxes paid in cash is taken in cash flow, subtracted here. Here I'm not talking about interest expense for the year. Interest expense for the year goes in the profit and loss account. But that does not mean that much you have paid. Likewise, tax for the year. Tax for the year could be an X amount, and what actually you pay could be a Y amount. So what you have paid is subtracted here, and you get cash flow from operating activities. And this is, I would say, 80% of cash flow itself. That's the most important one. Why? Because operating activity, cash flow from operating activities, assuming we have here, for example, 200 million. This cash flow from operating activity will tell you whether we have enough money for investing and financing. So I hope you have understood what is cash flow from operating activities, cash flows, inflows and outflows from buying and selling of goods and services. Now the second important part, which is the easiest, is cash flow from investing activity. When we talk about investing, primarily we are talking about buying and selling of non-current assets only. These are primarily your investments. So the idea is pretty simple. There is no rocket science in it. If you're buying a non-current asset, obviously there will be a cash outflow. Cash will go out. You're paying for that. But if you're selling a non-current asset, cash should be coming in. There will be a cash inflow. Have a look at this. So I've written here sale proceeds from non-current asset. So it could be sale proceeds from, for example, building. So it's without bracket, that means cash inflow. And then I've written purchase of non-current asset. Let's make it purchase of motor vehicle. So if you're buying, cash is going out. So that is a cash outflow. That means minus. So you net it off, put the final figure here. Let's say it's 50 million. Investing activity is done. The third one is financing activity. Financing activity, ladies and gentlemen, if you have a look at this, asset equal capital plus liability. If we have $100 of assets, assets are resources. So from where we got this 100? These could be the two possible reasons. If a company has $100 of assets, it's a resource. So what's the source, where it is coming from? It could be either capital, which you call shareholders' equity, or liabilities, which are debts. So basically these are the financing sources. Businesses' assets are either financed by the investors, the shareholders, or it is, financed by debt, the liabilities, the loans. So when I talk about financing activity here, I am looking at, is the business selling shares? Have they issued more shares? Have they taken new long-term loans? Have they repaid the loans? Has the business paid any dividends? So these are the areas we focus on in financing activities. Issuance of shares. It can be an issue or a redemption. That means either you have sold additional shares in the market and cash has come in, there is a cash inflow, or you have purchased your own shares from the market, which we call redemption of shares. In that case, there will be a cash outflow. The other aspect to look at is long-term borrowings. Long-term borrowings are new additional loans. So if you have taken a new loan, there will be a cash inflow. Obviously, when you take a loan, cash is coming in. But there can be a possibility that there is a repayment of loan. So there will be a cash outflow. If you're selling shares, money is coming in. But we have to pay dividend to the shareholders. So if there is a dividend, that would be a cash outflow. So I've just assumed here that the company has issued shares. It's without bracket. That means there is a cash inflow. Payment of long-term borrowings. That's why it's in bracket. That means there is a cash outflow. And then there is a dividend also. So if I just net it off, there is a possibility that I am getting a minus figure, let's say minus 20 million. So now what you have to do is cash flow from operating activities, cash flow from investing, and cash flow from financing. Let's say it's minus. You net them off. 250 minus 20 is 230 million. And ladies and gentlemen, this is a very, very important figure. Net cash flow. Net cash flow is a summation of cash flow from operating activities, cash flow from investing and financing. Now, why it is a very important figure? The beauty of cash flow is while you're working cash flows, you're making the statement of cash flow. At this point, you will get to know whether you have done it right or wrong. Now, you'll be asking why and how. Look, as I told you, we do get, comparative figures. In financial statements, we have comparative figures. For example, we're talking about year 2018 and 2019. And let's say we have cash balance. Cash. Let's say we have opening balance, 2018 opening balance of cash is 120 million. Now, your net cash flow, when you add your opening balance to it, which is 120. So your 230 plus 120, if you add, how much you will get? You will get 350 million. This should be your closing balance. So what I'm trying to tell you is, as soon as you calculate your net cash flow, when you add net cash flow to your opening balance, net cash flow to your opening balance, what you get should be equal to your closing balance of cash and cash equivalents. So, ladies and gentlemen, this was the format. Now let's go to a numerical example. I have a small question here, and this will make us understand how to prepare a real cash flow statement. We have comparative figures given here. For 2018, we have some current assets, non-current assets, liabilities, equity information given, as well as 2019. So let's look at how to prepare a cash flow statement. We all know that we do start with cash flow from operating activities. So I'm writing short forms. Cash flow from operating activities. The very first thing you need to look at is operating profit or net profit, whatever is given to you. So if I look at in the whole question here, net profit is given to me as 22,400. So life is easy, profit is given. I am taking net profit as, normally I start with operating profit, but because net profit is given, so I have taken net profit straight away. Net profit. How much? 22,400. So I'm writing it here, 22,400. As soon as I write operating profit or net profit, whichever is given to me, I have to look at, if it is net profit, I have to add back interest for the year and tax for the year, which appears in the profit and loss account. But coincidentally, unfortunately, it's not here. I cannot see interest or tax details. Okay, so let it be net profit. Next step is working capital adjustments. Please remember, we have to do working capital adjustment to net profit because net profit is calculated on accrual basis and we need to convert it into cash basis. So the very first thing is we look at current assets other than cash and bank balances. So the very first current asset I come across here is net receivables. Net receivable means that the provision or allowance for bad debts has already been subtracted. And this is how we have to take it. If we have account receivable figure and allowance for bad debts, you minus it. Take the net receivable for 2018 and then for 2019. So if you look at the receivable, which is a current asset, what is happening? From 11,500, it is going to 7,950. It is decreasing. So what I'm going to do is, I'm saying decrease in receivable, show the amount from 11,500, it is going down to 7,950. If I find the difference, I think it is 3,550. And without bracket means I have added it. Because as for format, decrease in current assets are to be added with your profit or operating profit. My next current asset is closing stock. See what is happening to closing stock over the years. It was 40,000 last year, now it is 36. So there is a decrease in closing stock again, decrease in closing stock. Show the working from 40,000 last year to this year, it is 36,000. So decrease in current asset is to be added. So I'm going to add it. The difference is 4,000. Without bracket, any figure means I'm adding it. Okay, do I have any other current asset? No, furniture is a non-current asset. Accumulated depreciation, accounts payable. Yes, I have to look at increase and decrease in current assets and liabilities. That's the working capital adjustment. So I'm done with the current asset, increase or decrease, whatever. Now I'm looking at the current liability. So if I scroll through here, go down here, accounts payable is a current liability, but debenture payable is a long-term liability. So I'm only looking at accounts payable. See what is happening to accounts payable. From 20,800 to 16,000. It is decreasing. Decrease in accounts payable. From 20,800, it's going down to 16,000. That is 4,800. Decrease in current liabilities are always subtracted. Decrease in current liabilities shows that a payment has been made. So that's why it is to be subtracted. So I'm done with increase and decrease of current assets and liabilities. Now I have to look at depreciation expense for the year, which is to be added here. Now why depreciation expense for the year is added here in cash flows? Because when we prepare the profit and loss account, we subtract depreciation expense among expenses like salaries, rent, insurance. Salaries we pay to the employer. Rent, there is a cash outflow. Insurance, we pay the cash, there is a cash outflow for that. But among expenses, we also have depreciation. We don't pay depreciation to anybody, but we do minus from net profit. Because it's a non-cash item, it has already been subtracted from the net profit. Now we're going to add it back. That's why if you look at accumulated depreciation, at the beginning of the year it was 16,000. At the end of the year it is 24,000. There is a change in accumulated depreciation, and accumulated depreciation will only change, increase if there is expense for the year. Like opening balance, add depreciation expense for the year, you'll get closing balance. So opening balance was 16,000. Obviously some depreciation expense of the year is added. That's why you have closing balance of 24. So I can simply take this as depreciation expense. Okay, always look at accumulated depreciation, the difference. 16 minus 2450, 16,000 minus 24,050. So that is 8,050. And all depreciation is added because it has been subtracted while preparing the statement of comprehensive income, and it's a non-cash item. That's why we are adding it now. So what I'm done with? I'm done with adjustment of working capital, increase and decrease of current assets and liabilities. I've looked at depreciation. Let's look at if there is any gain or loss on disposal of asset. So if I look at this whole information, there is no discussion and information about asset being disposed of. Even if I look at furniture, from 60,000 it is becoming 80. That means we have purchased, we have not disposed. So when we are purchasing the asset, we are not talking about gain or loss on disposal. It's only on sale. So we don't have gain or loss on disposal. So let's do the total. So if I add this, If I add 22,400, all these without brackets are added: 22,400, 3,550, 4,000, 8050, and minus this. So I'm getting 33,200. This 33,200 is my cash flow from operating activities. So I'm writing here short form cash flow from operating activities. The next part is cash flow from investing activities. So let's write the heading cash flow from investing activities. Now, ladies and gentlemen, I already told you investing activity is pretty simple. All we are looking at is non-current assets, primarily whether they have been purchased or sold. So if you look at the details here, the financials given here, the only non-current asset we have is furniture. And if you look at what is happening over the year, last year we had furniture worth 60,000. This year we have furniture worth 80,000. If there is no other information given, it means that it has been purchased, because the value of furniture will only go up when you purchase additional furniture. And normally it will go down, when you are disposing it off. So here it is very simple. The only asset we have is furniture. And if I look at these numbers from 60 to 80, it is increasing. That means there has been a purchase. Purchase would warrant for a cash outflow. So I'm writing here purchase of furniture and I can show the amount as 60,000 minus 80,000. And there is only one furniture, only one non-current asset. So straight away I can put this here as a cash outflow. Because we had only one non-current assets, it's already taken care of. Let's go to the third part, cash flow from financing activity. So a short heading here, cash flow from financing activity. In cash flow from financing activity, we have to look at, are we selling shares or are we redeeming shares? Have we taken a new loan or have we done a repayment? Have we paid dividends or not? So let's look at them one by one. So if I come here, the equity section, I have share capital. So if you look at the share capital figure, it was 56,000 till last year. This year it is 80,000. Please understand, if the share capital is increasing over the year, that means you have issued additional shares. So I can write here issue of shares. Show the working from 56 to 80, 56 to 80,000. That's 24,000. And it's without bracket. Without bracket means that's in cash inflow. Whenever you sell shares, cash comes in. There is a cash inflow. That's why 56 minus 80, I'm showing it as a cash inflow. All right. I also have debentures. Debentures are long-term loans. Another name for debenture is bonds. You may find in some ACCA books as loan notes. So depends which qualification you are, looking at. O-levels, A-levels, ACCA, CA, CMA, different terms are used, but they are quite used interchangeably. So whether it is bonds payable, debenture payable, mortgage loan, loan notes, they all mean the same, long-term liability. So what's happening here? Right up till 2018, your debentures were, your long-term liability was 20,000, and now it's nothing. Primarily, it means that it has been paid off. When you pay a loan, there is a cash outflow. So that's why I am writing here payment of debentures. Payment of debentures from 20 minus 0. 20 minus 0 is 20,000. Because it's a payment, it's a negative cash outflow. And finally, if you look at ignoring retained earnings, I'll tell you retained earning is basically used to calculate profit. Profits were already given to us in the question if you can, if you have a look at this. So now I'm coming to additional information. Net profit 22,400. That's what I started my cash flow with. It also says dividend paid during the year amounted to $20,000. So dividend paid, that means cash outflow. Cash outflow, it has to come in financing activities. Dividend paid. How much? 20,000. So I'm taking 20,000 here. Payment, it's a cash outflow, that's why in brackets. So now you got to net it off. So if you look at minus 20 and minus 20 is minus 40. Minus 40 plus 24 will give you minus 16. This is your cash flow from financing activity. Once we have all the three cash flows, if you look at this, cash flow from operating, cash flow from investing, cash flow from financing, you just add them up. So if you add them up, you will get net cash flows. So we are talking about net cash flow. So 33,200 minus 20 minus 16 will give you minus 2,800. So your net cash flow for the year is in negative. In other words, it means whatever cash came in, whatever cash went out, the total cash inflows were less than the total cash outflow. By how much? By 2,800. Your outflows exceeded your inflows by 2,800. Now, the most important part of the question. Once you have net cash flow for the year, which is the, net off of all the three activities, look at the opening balance. Guys, you're given 2 years, 2018 and 2019. 2018 shows you all the opening balances for the year. 2019 shows you the closing balances for the year. So what is the opening balance of cash for 2018? If you could see, we have cash 9,700. So I'm going to add here, add opening balance of cash and cash equivalents, which is 9,700. Now if I net it off, 9,700 is a positive amount, 2,800 is negative. If I minus, I am getting 6,900. And this I can call as ending balance or closing balance of cash and cash equivalents. My cash flow statement is correct, because if you calculate this amount wrong, your net cash flow, if your net cash flow is not correct, and when you add the opening balance, you will not get your closing balance, which will match with your closing balance here. So that's a litmus test. Net cash flow, add opening balance, has to be equal to the closing balance which is given in the question. So if your net cash flow is not correct, when you add the opening balance, you will not get this amount equal to this amount. So guys, now that you know how to prepare a cash flow statement, some final points. Now obviously this is a very simple question, but there are many other possibilities. You may be given some additional information. Especially if you look at in this question, net profit was already given as 22,400. Now what if net profit is not given? Then what do? We simply prepare a T account for retained earnings. Okay? We prepare a T account for retained earnings. Have a look at retained earning opening balance. Retained earning is an accumulated profit account. All profits normally have a credit balance. So is for retained earning. So opening balance would be a credit balance. Brought down 8,400. Normal balance of a retained earning account, unless there is a loss, would be a credit. So closing balance would be a debit, which is 10,800. Please remember, whenever dividends are declared, the double entry is retained earning debit, dividend payable credit. So here dividends are declared and paid, so obviously it would have been declared. So I'm putting here dividend on the debit side, which is 20,000. So now when I add these two, this will give me 30,800. When I minus 8,400, I'll get profit for the year, which is 22,400. So it is 30,800. And if you look at this T account, now it makes sense how when the year began, the opening balance of the profit was 8,400. During the year, profit credited to the retained earning account is 22,400. Total profit 30,800. From this 30,800, dividends were declared and paid 20,000. So what is the closing balance? 10,800. So please remember, when net profit figure is not given, prepare a retained earning T account. Put the opening balance and the closing balance at the required position. Normally opening balance is a credit, closing is a debit. If there are any dividends, any new reserves created, you put on the debit side of the retained earning account, and the balancing amount would be profit for the year. Another important point to note is the purchase of non-current assets. If you look at this question, it's given very straightforward. Like if you look at this furniture amount, from 60 it becoming 80, that means you have purchased for 20,000. But it may not be given as straightforward. There is a possibility you are given details like this. For example, year 2015 and 2016, you are given 2 years, and you are given the value of non-current assets. For example, motor vehicles. Opening balance could be 20,000 and closing balance could be, let's say, 70,000. And you are also given a detail that during the year you have sold motor vehicle costing, let's say, another 30,000. Now what to do? If you look at it, it doesn't make sense that if the opening balance was 20,000 for motor vehicle, how can you sell motor vehicle worth 30,000? That's not possible. It's just that if I have $10,000 in my pocket, how can I spend 12,000? I can spend maximum 10, not 12. Likewise, if the start of the year, if you have motor vehicles worth 20,000, you cannot sell motor vehicles for 30,000. That means something important happened during the year. So in this situation, what you do is just prepare a T account for motor vehicles. Motor vehicle at cost. Because motor vehicle is a non-current asset, opening balance of an asset normally is a debit. So I'm putting on the debit side 20,000. Closing balance would be on the credit side 70,000. And when you buy motor vehicle assets, you debit. When you sell, you credit them. So when you disposed it, you sold it, so disposal will come on the credit side, which is 30,000. So now when you add these two, this is 100,000 minus 20, you will get purchase of motor vehicle, which is 80,000. So now if you look at this T account, it makes absolute sense how when the year began, you have motor vehicle worth 20,000. During the year, you purchased motor vehicle worth 80,000. The total balance in the motor vehicle is 100,000. From this 100,000, during the year, you disposed of, you sold 30. That's how you got closing balance at 70,000. So what you need to know is, there can be complications for purchase of motor vehicle. If that is the case, you have opening, closing balance, disposal of the same non-current assets, prepare a T account and find the purchases. Once you get the purchases, that goes here in your investing activity, purchase of motor vehicle. You may also be given data relating to disposal of assets. there's sale proceeds, accumulated depreciation. For example, cost of building 50,000, having an accumulated depreciation 20,000, net book value 30,000, sale proceeds, that means sold for, let's say 45,000. So obviously a building having a net book value of 30,000, if you are selling it for 45,000, you are making a gain of 15,000. This is gain on disposal. So if there is a gain on disposal, as per IAS 7, all gain on disposal of assets are subtracted in the operating activity. Had there been a loss, it would have been added in the operating activities. This sale proceeds, which is 45,000, because you're selling, you're getting the money, that will come as an inflow in your investing activities. Because you've sold an asset, you got the money, it will come as an inflow here. This accumulated depreciation 20,000 will be used to calculate depreciation for the year. How? Have a look at this. So there is a possibility that you may have accumulated depreciation, opening balance. Always accumulated depreciations, provision for depreciations are contra asset account. All contra asset accounts has a credit balance normally. So accumulated depreciation will have an opening balance on the credit side, let's say 20,000. We don't know depreciation for the year. Okay, but it has some closing balance. Closing balance of, let's say, 40,000. And disposal. And we know that whenever an asset is disposed, the accumulated depreciation on that disposed of asset is closed. To close accumulated depreciation on disposal, the double entry is we debit the accumulated depreciation. So that would come here. Depreciation on disposal of asset, let's say 30,000. So what's going to happen now? You're going to add these two. That will give you 70,000. From 70,000 you minus 20, you will get depreciation for the year, which is 50,000. And as I always say, now this account makes sense. Why? When the year started, your accumulated depreciation was 20,000. Assets were used, they got depreciated during the year, 70,000. So total depreciation, 70,000. Then you sold some asset and the depreciation on that asset was 30,000. So you just finish it off, putting it on the debit side. So 70 minus 30, your closing balance for provision is 40,000. This 50,000 will go as depreciation expense here in your operating activities and would be added obviously. Now some further discussions on it. What is the meaning of cash and cash equivalents? Cash equivalents are highly liquid assets which can be converted into cash in the shortest possible time without losing significant value. And when I say, cash equivalents, one of the best examples are short-term investments. And as per IAS 7, when we are talking about cash equivalent or short-term investments, we are talking about investments with the maturity, of around 3 months' time. Please remember, as per IAS 7, when we talk about short-term investments, that does not include shares of other companies because those shares have been held for investment purposes. But there is an exception. If you have redeemable preference shares which have been purchased very close to their date of maturity, that can be included in cash equivalents. As per IAS 7, interest paid and interest and dividend received should be taken into operating activities if you are a financial institution. If you are not a financial institution, then interest paid can go in operating activities. As I told you in the format, interest paid can go here. It can also go in financing activities. And interest received and dividend received should go in your investing activities. According to IAS 7, the payment of dividends can go into, operating or financing activities. So ladies and gentlemen, I hope you understood how cash flow statements are made, why they are important. Please keep in mind, academic purpose is one aspect. Yes, for passing so many exams, like there are different papers in ACCA, CMA, CPA, BCom, MBA. Yes, you need this information. You are asked to prepare cash flow statements. But if I talk from the practical aspect, if I am a banker, somebody comes for a loan, yes, I look at their cash flow statements, their ability to generate cash. If a business is not able to generate cash, they may not be able to pay back their loans. Cash flow statements are also important for investors who need to invest in different companies. They have to look at their cash position. They have to look at their ability to generate cash, the liquidity, their solvency. Cash flow is also important not only for investors, but also when we're talking about business combinations, mergers, takeovers. Very important area. Any further question if you have relating to cash flow, please put it in the comment section and I'll get back to you. Ladies and gentlemen, thank you so very much for your precious time. Hopefully I'll see you with a new video very soon. If you like the content, please subscribe to my channel, give me a thumbs up, and don't forget to share this video with your friends, family members, relatives, those you know, so that others can also benefit. Thank you so much.